Welcome you all again. Last video we have seen the capital markets for first to third units. Now we are going to see about 4 and 5th unit. I am KAVYA, assistant professor from School of Commerce from KSR College of Arts and Science, Fortnite. Now we are going to see about the SEBI. SEBI, Securities and Exchange Board of India, is the regulatory authority that oversees and regulates the securities and capital markets in India. It was established by the Government of India to protect the investors' interests, regulate the securities market and promote its orderly development. The definition of SEBI is the statutory regulatory body responsible for regulating the securities market, protecting the investors and ensuring the fair and transparent market practices in India. Next is the objectives of SEBI. Protect investors' interests, safeguard investors from unfair and fraudulent practices, promote the development of securities market, encourage growth and efficiency in the capital markets. Regulate the securities market, ensure fair, transparent and orderly functioning of the market, prevent malpractices, curbs insider trading, price manipulation and other unethical activities, increase investor awareness, educate investor about investment opportunities and risks. Next is functions of SEBI. The functions of SEBI is categorized into three categories, that is protective functions, regulatory functions and development functions. Protective function protects the investors' interest, prevent insider trading and fraudulent practices, promotes investors' education and awareness. Regulatory function regulates stock exchange and securities market, register and supervises market intermediaries such as brokers, merchant bankers and mutual funds, frames rules and regulations for market participants. Next is development function, promotes innovation and modernization in the securities market, encourages fair trade practices, conducts research and training programs related to the securities market. In brief, SEBI is the regulatory authority of India's securities markets. Its main objectives are investor protection, market development and market regulations, while its function include protective, regulatory and developmental activities. Next is powers of SEBI. Regulatory power, investigative power, or power to issue directions, power to impose penalties, power to prevent unfair trade practices, power to suspend or cancel registration, quasi-judicial powers. Next is derivatives. The derivatives is very interesting topic. We are going to see about that. A derivative is a financial contract whose value is derived from the value of an underlying asset such as shares, bonds, commodities, currencies or market indices. Simple definition: a derivative is a financial instrument whose price depends on its derived from another asset. For example, if a price of a wheat future contract depends on the future price of a wheat, then the contract is a derivative. Hedges: use derivatives to reduce or eliminate risk of prices. For example, a farmer uses a future contract to lock crop prices. Speculators take high risk in the expectation of making a profits from the price movements. They do not own the underlying asset. For example, traders betting on stock price rise or fall. Arbitrators profit from the price difference in the different markets. They buy in one market and sell in another simultaneously. Next is margin traders or market makers. Provide liquidity to the market by continuously buying and selling derivatives. Helps in smooth functioning of trading. In brief, the main participants of the derivative markets are hedgers, as risk reducers, speculators, risk takers, arbiters, price difference exploiters and market makers, liquidity providers. Thank you for your valuable time.